Solid US producer prices add to signals the Fed will be cautious in November. South Korea cuts rates, but looks to pause, and Chinese inflation is weaker than expected, with traders also underwhelmed by Saturday's stimulus briefing. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior China strategist Zhaopeng outlines why that weekend briefing by China's finance ministry did not deliver what investors were looking for.
I think the investors will have to wait for the NPC standing meeting to be held later in October to know the exact amount.
But first in 5 and 5 with ANZ. US equity markets will start the week with another lift on Friday. The S&P 500 closed up 0.6% as earnings season kicked off. This was despite growing whispers last week around prospects of the Fed pausing rate cuts. The market ended the week pricing about a 90% chance of a 25% basis point cut on November the 7th, compared to 97% at the start of it. ANZ head of G3 Economics, Brian Martin, says some strength within producer price data on Friday added to signals the Fed will tread carefully. Here is Brian talking about core PPI.
I think that the 0.2% rise in producer price inflation, coupled with the firmer than expected core CPI reading we had for September, does indicate upside risks to the market consensus that core PCE inflation rose 0.2% last month. When we take the inflation numbers and the labour market data for September and put them together, I think what it means is the FOMC will need to proceed cautiously with regards to rate cuts going forward, paying due attention to both sides of its dual mandate.
The US dollar closed flat on Friday, but had climbed through the week as rate cut bets were reduced. The Aussie dollar will start the week at 67.50 US cents and the Kiwi at 61.09 US cents. Number 2. In Australia this week, the key data for the RBA will be the September jobs report on Thursday. ANZ Chief Economist Richard Yetzinger expects unemployment will stay at 4.2% as the jobs market retains the strength which has surprised the RBA.
If you were to pick one indicator, CPI in Australia has been a bit different from other places in the sense it's been stabilising while in other economies we've seen declines, but it's employment that's really been the standout, and that employment number needs to come back to the pack if the RBA is going to ease before the end of the year as the market is pricing. I do think we are due a weak employment number. I doubt we'll get a number that's weak enough to really encourage where the market is. It still seems to us more likely that the RBA doesn't ease until February.
Number 3. South Korea's central bank cut its key rate by 25 basis points to 3.25% on Friday. Despite the move being widely expected, ANZ economist Crystal Tan says it turned out to be a hawkish cut, with one decision-maker dissenting.
Most members also signalled a pause on the 3-month horizon, so a follow-up cut at the Bank of Korea's next meeting in November is not on the cards. Further easing is a matter of time though, as current monetary policy settings are still restrictive. The pace will be dictated by the trajectory of household debt growth and housing prices. The Bank of Korea's easing cycle will be shallow and gradual, with penciled in a 25 basis point rate cut each in Q1 and Q2 next year. That would take the terminal policy rate to 2.75%.
Number 4. New Zealand's manufacturing PMI rose 0.8 points in September to a still contractionary 46.9. ANZ economist Henry Russell says while that's consistent with an improving outlook, a full recovery doesn't look likely until into 2025.
We've seen, particularly through the second quarter of this year, that monetary traction was starting to pick up, and the prospect of no OCR cuts until August 2025, as the Reserve Bank's guidance was at the time, that weighed heavily on sentiment and saw the PMI plunge to very low levels. But over the past 3 months, now that interest rates have fallen and the Reserve Bank has kick-started its easing cycle and in fact accelerated, that's certainly supporting the recovery we're seeing. But at 46.9, the PMI still remains in contractionary territory. So it's certainly not strong in any sense of the word.
Number 5. China's annual consumer price inflation was 0.4% in September, while producer prices fell 2.8%, both well below market expectations. ANZ senior China strategist Zhaopeng says there were 3 big reasons for the weakness.
The first one is the high base. Last September, inflation was improved in China. The second reason is the weak energy price. Oil price dropped a lot in September. The third reason is insufficient demand. Generally, the China policy stimulus has no immediate impact on the headline figures. So we still need time to wait for the improvement in inflation.
Zhaopeng Xing there, who we stay with for our bonus deep dive interview on the Saturday stimulus briefing by China's finance ministry. Zhaopeng says many investor questions were still left unanswered.
The Ministry of Finance announced 4 major measures. The first is to increase the local bond limit to replace the local implicit debts. The second is to add capital to state banks. The third is to use the local bonds and tax policy to support the property market. The last is to double the supports to students.
How did the announcement stack up against what investors were looking for?
The announced policy is not as strong as investors expected because no clear amount is mentioned at the briefing. I think the investors will have to wait for the NPC standing meeting to be held later in October to know the exact amount. In our expectation, we forecast the Ministry of Finance and the authority to increase 1 trillion yuan special treasury bonds and 1 trillion yuan local bonds in the rest of this year.
From what we heard, will the focus be on short-term or long-term growth measures?
My perception is that the Ministry of Finance emphasizes on de-risking, not short-term growth. De-risking will be good for long-term structural growth. Even the 2024 budget will be revised. We expect there will be no immediate impact on growth and inflation. We expect more policy supports to consumers and households. China has lowered the mortgage rate for home buyers, but that's not enough. We expect more rate cuts to go in the next year. For fiscal policy, we expect a tax cut and a social security fee cut to be announced at the NPC meeting to be held in March next year.
And so what are you expecting to see in China's Q3 GDP and retail sales data on Friday?
Our forecast for Q3 GDP is 4.7. Comparing with Q2, Q2 was also 4.7. The rebound in service value added will offset the decline in industrial value added. So the GDP reading is expected to be flat. In our view, retail sales is highly correlated with domestic consumption. Only slight difference between the two. In retail sales, half retail sales are bought by government and the rest half are bought by households. In China GDP accounting, government contributed 30% and households contribute 70% to final consumption. So the difference is in the weight. We expect a rebound in retail sales in September, benefited from the trade-in policy support for consumption goods.
Zhaopeng Xing there. I'm Alex Tarrant, standing in for Bernard Hickey, who was away this week on family leave. That was 5 and 5 with ANZ for Monday, October the 14th. Catch you tomorrow with key data on China's trade balance and a monetary policy decision from Singapore.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.